Good evening and welcome to the Planning in Uncertain Times Farm and Ranch Estate and Income Tax Planning webinar provided tonight by the Women Managing the Farm and K-State Department of Agricultural Economics. I'm Lavelle Windsor and I will be your host this evening. I'm a farm analyst with K-State Research and Extension. And in short, that means that I work with farmers and ranchers across the state of Kansas on issues that impact their financials. As I mentioned, the Women Managing the Farm and K-State Department of Agricultural Economics is providing the webinar tonight. I'm pleased to announce that the 2022 registration for the Women Managing the Farm conference is now open on the website. The conference will be in Manhattan, Kansas, February 10th and 11th, with an optional pre-conference on February 9th. And I see that Robin has just dropped a link to the website in the chat box if you would like to register for that conference. Without further ado, let's get started with the webinar. I want to welcome Roger McCowan. This evening, Roger will discuss some of the uncertainties around legislation and estate and tax planning that impact farmers and ranchers. Many of you are familiar with Roger's work, so I'll just give a brief background. Roger McCowan is professor of agricultural law and taxation at Washburn University School of Law in Topeka, Kansas. He was director for the Iowa State University Center for Agricultural Law and Taxation. Before joining Iowa State, he was an associate professor at Agricultural Law and Extension Specialist in Agricultural Law and Policy at Kansas State. Roger also teaches an undergraduate course in agricultural law at Kansas State University. Professor McCowan conducts approximately 80 to 100 seminars annually across the United States. He also conducts 2 radio programs, each airing twice monthly, heard in the Midwest and on the web. Roger's latest venture is his 2-minute radio program, the Agricultural Law and Tax Report, and is heard each weekday by over 2 million listeners on farm radio stations. Thank you for being with us this evening. As we go through the presentation, if you have questions, please type them into the chat box and we will have time after Roger's presentation for questions. I know we're all looking forward to learning more, and I'll let you get started, Roger.
Okay, thank you, Lavelle. And one more thing, Lavelle, before you step aside, why don't we do a volume check for people that are online, and in case anybody's having trouble hearing, maybe there's something that you can suggest that they do.
Okay, if anyone is having problems, please type that into the chat. Let us know, and we will make the necessary adjustments.
Okay, sounds good. And you may want to put that in the chat in case someone can't hear what you just said, so they can pick it up that way.
All right.
Okay. Well, thank you very much. And in the limited time that we have this evening, we've got a lot to cover. And here's my contact information for you. And I certainly appreciate Women in Ag's invitation to speak to you this evening and talk about some very important issues and a lot of questions that are out there. And we may have had some of those answered in recent days with the bill that has recently passed the House and is now on its way to the Senate. But if you're not familiar with my contact information, here's where you can find me or how you can get in touch with me. That's my email address, my website, and through the website, there's a lot of information there for you on my website, including my speaking calendar out for the next couple of months, actually through December. I need to update it to add in January and February events. But also on the homepage of that website, as you go down the left-hand side, you can find a link to my blog. And about 130 times a year, I write a detailed article having something to do with agricultural law or agricultural taxation. And indeed, today's post is going to comprise most of what we're going to be talking about this evening in terms of where are we at legislatively. And how does it impact potentially your farming or ranching operation? What's in the bill? What's out of the bill? Unfortunately, as you'll see, there are a lot of things that got dropped out. We're on the cutting room floor before before the House voted on the bill, and so that is reassuring to many of us in agriculture. If you're into Twitter, I would encourage you to follow me on Twitter, and I'll try to follow you back also. But the reason for that, I use Twitter. Twitter can be an absolute sewer, but I use Twitter for educational information. I get a lot of quick hitting IRS information. As soon as I see it drop, I'll go to Twitter with it, with links to IRS pages or other, court cases, those types of things. That's how I use Twitter and Facebook also. I don't use them for personal reasons, but educational reasons. And feel free to follow me if you're into Twitter. That would be, I think you would find it helpful. Well, let's get started, and I'll give you a brief overview of a very long blog post. It's about 2.5 times my normal length of a blog post, the one that was posted today. And this focuses on what just passed the House. The House voted on what's known as the BBB, or Build Back Better law, the Build Back Better Act. The bill number is HR 5376. So that's how I tend to refer to it. And they passed that on a 220 to 213 vote, purely partisan, with one Democrat voting with the Republicans, and all of the Republicans voting against it, Democrats voting for it, except for that one. It's presently before the Senate, and I would say it's not nearly as bad from agriculture standpoint as it could have been. And I think the provisions that were struck are not likely to be added back by the Senate. I don't think any of them will actually be added back in by the Senate. So what's not in the bill? Let's start with that. Let's start with the good news first. Well, there's no increase in the corporate tax rate to 26.5%. So the TCJA, the Tax Cuts and Jobs Act that went into effect starting in 2018, keeps the corporate rate at a flat 21% rate. So there's no rate change with respect to corporate tax. We'll see that there's something else that changes concerning corporate tax, but not the rate. So we stay at 21% flat rate for corporations. Modification to the stepped-up basis rule at death is not in the bill. That is a big one for agriculture. We were very concerned about that. Any change to the rule that says that you get a fair market value basis at death in the hands of the heirs would affect all agricultural states, and this is a big issue. And so what they were proposing initially was a kind of the Canadian version, I suppose, of basis at death rule. It's a modified stepped up basis rule where you would get the first $1 million of step up, and then you would have a carryover basis on any amount in excess of the $1 million. Plus, you could exclude the $500,000 gain attributable to the principal residence. Increase the top individual marginal rate to 39.6% is not in the bill. So that top end stays at 37%. Capital gain rate stays top end 20%. It did not go to 25%, so no increase in the capital gain rate. No reduction. Here's the other big one. No reduction in the federal estate or gift tax unified credit exemption equivalent. That's going to stay at the current 11.7 million, which will be 12.06 million next year. So that stays on the same trajectory as in the Tax Cuts and Jobs Act. Now, what that does is push off the reduction down to 5 million plus an inflation adjustment to 2026. So we are under the TCJA now, with this still remaining under that, and that will sunset at the end of 2025. And so that is scheduled, if Congress does nothing between now and the end of 2025, to go back down to 5 million with an inflation adjustment in 2011 dollars, which would probably put it in 2026, probably it's somewhere in the $7 to $8 million range, but no change right now. So just to reiterate, that exemption will be 12.06 million next year, and you will have a stepped up basis at death. So no change on that. Those are two very, very important ones. No change in the grantor trust rules. That's very important also, because that would have basically eliminated a lot of trust planning that we do for wealthier clients, such as the irrevocable life insurance trusts and the grantor retained annuity trusts. So those are still techniques that we can use. And the basis rules and the tax rules associated with funding and distributions from grantor trust, those rules don't change either. So that's also very good from a planning standpoint. No change in the present interest annual exclusion rule. So you can still make gifts of up to $15,000 per year this year to as many people as you wish or your funds allow. And that is not treated as a taxable gift. And so you don't use any of your unified credit exemption to offset that. That amount will go to $16,000 next year per donee. Increase in the top federal estate gift tax marginal rate, not in the bill. So that's going to stay at 40%. We still can use valuation discounts on minority interests or interests in entities that lack marketability. We can gift those interests. We can also pass them at death and use valuation discounts. So the valuation discounting rule change was not included in HR 5376. And because there was no change in the unified credit exemption and there was no change in the basis step-up rule at death, hence the proposal to increase the maximum amount you can reduce ag land in a decedent's estate, the value of that in the estate under a special use valuation was not necessary. And so that was also not included in HR 5376. So that's the big news right there. I think there's some major ones right there. The basis step up, rule change, no rule change on that. We get to keep the exemption, basically $12 million. We can use valuation discounting with no change on the rules with respect to grantor trust. So really, from a transfer tax standpoint, we didn't have any change. And if you recall, some of you may have attended a major farm event I did in Iowa City, Iowa in June. I keynoted one of the Farm Journal conferences this past summer. And one of the things I said there, and then they did a substantial article quoting I sat down and did a long interview with them. It turned into a long article in one of the magazines and put percentages on what I thought would and would not happen. And turns out I got it pretty close to correct that they would not do much. There'd be a lot of blustering about changing the rules associated with estate planning, business planning, but the percentages of the likelihood that they would actually do something was pretty low. And thankfully, I got that correct. So I lucked into that one. But this is the good news. Now, what's not so good in terms of what's included in HR 5376 that the Senate is looking at? Well, let me go through these pretty quickly. And again, all of this is in my blog article that I posted early this morning. If you listen to WIBW radio out of Topeka this morning, I devoted the 6 a.m. to 6:30 a.m. show, the Ag Issue Show with Greg Kagi, to the article. Paid leave is excluded from gross income. The state and local deduction for state and local taxes, which is currently capped at $10,000, goes to $80,000 on a married filing joint return and $40,000 on a married filing separately return or in a return for an estate or a trust. Now, this one is retroactive back to the beginning of this year. And so if this passes, if this stays in the bill, for those individuals primarily that are in high tax states, this is a benefit to them. Now, that's not necessarily just limited to situations where you're in a high tax state. You can have people that have multiple homes, have a lot of farm and ranch land, paying a lot of property tax on that, particularly in states, high property tax states such as Nebraska. This can be very helpful. So that's currently $10,000 as a result of Tax Cuts and Jobs Act. That limit would, now this is an interesting one. In terms of its impact, this is actually a tax increase followed by a tax cut. And let me explain what I mean on that. The current law is a $10,000 cap until we get to 2026, and then there's no limit. Okay, so now you go to 80,000, which is a tax cut, and then it's going to be 80,000 compared to what TCJA would have been, which would have been unlimited. So that's a tax increase. starting in 2026. And then this one's going to go to 2030. Then the cap's going to go to $10,000 for 2031, and then no cap for 2032 later years. Now, they did that because of budget reasons. That's a budget trick that they're doing right there. But that's a big issue for some in agriculture. Modification to the child tax credit. They threw in an IRS recapture provision. So this is one of the tighter things that they did to really turn the screws down on this. And what they said was IRS can recapture, in other words, get the tax benefit back of having provided the child tax credit anytime the IRS determines that a child was taken into account when determining the annual advance amount due to fraud or intentional disregard of the applicable rules. So if there's fraud in trying to claim a child as your child, for example, when they're not really your child, to gin up another tax credit, then IRS has the authority to claw that back. What also has happened with the child tax credit, and there are different versions of this. We had the TCJA version, then we had a 2020 version, then a 2021 version. And so what they've done is they've taken the 2021 version and extended it through 2022 and made it fully refundable, increased the age limit. So the age limit of a qualifying child goes to those not having reached age 18 rather than 17. And then an increase in the amount of the credit. And again, there are two pieces to this as a result of the virus-related changes to the child tax credit. Children up to age 6, and then the ones up to 17, now 18. You have different levels of the credit. They've increased those amounts and then changed the phase-out ranges too, so that more people can take advantage of it. It is refundable for tax years beginning after 2022, and then no provision for those advance payments after next year. What happened kind of midstream this year was that they front loaded the child tax credit, and instead of claiming it fully on the return for the previous year when you file the tax return for that year, you can get a 12th of what you're anticipating the credit would be every month. So you have the IRS sending you a check every month for the child tax credit. That will continue through 2022, but then that will cease under the current version of what's in HR 5376. Earned income tax credit. This one is extended through 2022, and the reduction in the age limit to claim the EITC goes to 19. It's from 25 to 19, except for certain full-time students. And they eliminated the upper age limit for the childless version of the EITC. And you can also use, one of the other things that they said, you can use your prior year earned income for EITC computational purposes if the earned income in the current year is less. So really opened that one up too. They've also opened up a lot of fraud potential with this also. The EITC is known, it has a history of a lot of fraud associated with it. So we'll probably could anticipate those problems continuing. Pell Grants. What they've said is that now if you're not going to use Pell Grants, or if you're going to use Pell Grant money for non-qualified purposes, they're still not taxable, even if they're not used for qualified tuition and related expenses. They're just saying Pell Grants not taxable starting next year. There's a surcharge that's included in the bill on high income earners. This is a initial out of the box 5% surcharge on a taxpayer's modified adjusted gross income exceeding $10 million on a married filing joint return, half of that for a married filing separate return, plus an additional 3% for the taxpayer's modified adjusted gross income that exceeds 25 million. So you have two steps to that. Hopefully that's a problem for you. Hopefully you worry about that, but that's not going to affect that many taxpayers. Extended expansion of eligibility for the premium assistance tax credit that's created under Obamacare to help pay for the cost of health insurance acquired through the exchanges, and an exclusion for certain dependent income from household income. In other words, what this means is normally once you got to 400% of the federal poverty level, you couldn't claim any premium assistance tax credit. That's changed. That was changed because of the virus-related legislation. That's now been expanded, and they're saying in your computation of household income for purposes of the amount of the credit that you can claim, certain dependents in your household, you don't count their income. So again, the loosening of the rules with respect to that. Also, addressing some court cases that are out there that have held otherwise. This bill excludes from income any lump sum payment of Social Security benefits that you received during the tax year from a prior year. The Social Security benefits in general count toward eligibility for the premium assistance tax credit. In other words, they're treated as income in that computation of how much income you have to see how much premium assistance tax credit you're entitled to. And once you get over 400%, then you're not entitled to anything under the original rule. A lot of court cases out there, and just one last week that I summarized and posted on my website in my annotations list over the weekend, said, yeah, we include all gross income in your computation of income for purposes of the premium assistance tax credit. And so what this would do is reverse that case and the other cases where the courts have held otherwise. Now, on the business side of things, and we have some important provisions that are still in here that will impact the structure of our businesses. And so we need to pay attention to this. First one is business interest deduction limitation that came in with respect to the TCJA. There's a limitation on the amount of business interest that can be deducted if you get over a certain level of income. We're basically looking at those businesses that have gross receipts in excess of 25 million, inflation adjusted, sitting at 26 million, then 27 million. They have a limit on the amount of business interest that they can deduct. And then if you're over that limit, there's a change in accounting method rule that's also into play too. But what they've done here is say, well, we're going to change that interest deduction limitation computation from the entity level to the partner or shareholder level. If we're talking about a partnership or a corporation, we're going to compute that at the individual level rather than the entity level. I think, frankly, from an accounting standpoint, that really cleans that up. And it's more appropriate to compute that at the individual level rather than the entity level. Now, a bigger one that we really have to be concerned about from a planning standpoint, because this could affect the structure of our businesses and how we go about structuring businesses. An expansion of the net investment income tax, which is section 1411 of the code, NIIT, to trade or business income for taxpayers that have incomes over 400,000 on a single return, 500,000 married filing joint. Now, let me explain this a little bit. What this is, the NIIT is a passive tax. It's a tax created under Obamacare. It's an additional 3.8% tax on passive sources of income, non-trader business income. So your cash rent lease income, your investment income, those types of things would be subject to this tax once you get above certain thresholds. The current rules are 200,000 single, 250,000 on a joint return. Now, but that is never applied to passive sources of income. Has never applied to trader business income. This flips it around and says not only does it apply to passive income, but also your trader business income that's not subject to FICA tax. It's going to apply it to all of that. And it'll apply it to the trader business income of estates or trusts. This can have implications. Now, what are the implications of this? I think this has implications with respect to the use of S corporations. So if we have an S corporation, and a lot of the reasons we use S corporations is to minimize self-employment tax, because under the rules, we have to pay ourselves what's known as reasonable compensation. And we know our Social Security wage base is sitting there over $142,000 right now. Well, we're paying the full load of Social Security tax up to 142. I think it's 142.7 under current rules. Going to go to about 147,000 next year. But if I pay myself, say, half of that amount as my compensation in an S corporation, and I pay the self-employment tax, the Social Security tax on that amount, then the rest that I get out of my corporation or out of my partnership comes as a draw. It's not subject to Social Security tax. So I pay myself this salary, this guaranteed payment. The balance that I'm getting from my business, my S corporation in particular, is coming, but not subject to Social Security tax. That's known. This is a pretty famous loophole. There was a politician that ran for president a number of years ago. I think his name was John Roberts. I think that's right, from North Carolina, and he was famous for using this. A lot of politicians use it. Shoot, I use it myself. But and we use it for clients that are primarily in professional service businesses. And we'll set them up, pay them a reasonable salary based on the current IRS rules concerning what that might be. We don't have to go all the way to the wage base. And then we save the difference, 15.3% on about $70,000 to $80,000. So this thing can add up. And we like to see about savings of $10,000 to $12,000 in tax when we utilize that technique. If this passes, then I think we've got to do a reevaluation of the use of S corporations for a lot of people. Disallowance of excess business losses for non-corporate taxpayers, the EBL rule, that would be gone. Reinstatement of the corporate AMT. Now, I said earlier, one of the things that's not in the bill is the increase in the corporate tax rate. But what they're doing, they left that the same, but they're bringing back the corporate AMT. Now, all of these have sub details to them that I'm not getting into just simply because we don't have time to, but those, you can read those details in my blog article. Debt on direct farm loans that's forgiven to a socially disadvantaged and economically distressed farm borrower is not income under a provision that's still in the bill. And then a change in the tax rule involving divisive reorganizations, or a change in one of the tax rules involving divisive reorganizations. Where we're reorganizing businesses, reorganizing a corporation into some other form of business venture. There's a significant change in the tax rule there. A change in the small business stock tax rules. Now, this one does not apply to agriculture because by rule, someone engaged in farming cannot use what's known as Section 1202 stock. But there's a change in the small business stock tax rules. And really, when I look at that rule, it doesn't make any sense to me as to why they did that. It's not intuitive at all. And an increase in employer-provided child care credit. Then we get into the energy provisions, and just very briefly, there are a lot of these that are still in the bill. I'll just touch on a few of them. They've extended through 2026 the credit for electricity produced from renewable sources, and applied the credit to electricity produced from solar energy. They've extended the biodiesel and the renewable diesel tax incentives, and the alternate fuel credit and the alternative fuel mixture credit. Also extended the residential energy efficient property credit through 2033 and modified the phase out rules. So that's a big one for a lot of people that are putting in energy efficient property at their residences. Extended through 2031 the credit for new energy efficient homes. And they made some changes to the existing credit. On the IRA front, some significant changes to IRAs, primarily for those that have a lot of money in their IRAs. They're limiting contributions to traditional or Roth IRAs for persons with combined IRA and definite contribution account balances exceeding $10 million, and where their adjusted taxable income exceeds $400,000 on a single return, $500,000 on married filing joint return. And also for those people that have, when you combine all of their account balances in their retirement accounts, not only are there limitations on contributions, but then there are required distributions. Once you cross that $10 million threshold, you have to distribute a certain percentage of any amount over 10 million. And a bigger one, I think, that will affect more people rather than just the ones that have large sums in retirement accounts, is that they are eliminating what are known as backdoor Roths. So you cannot convert a tax-deferred employer-sponsored plan and accounts and traditional IRAs, for example, to Roth accounts by going ahead and paying the tax on the current balance to receive tax-free future growth. Now, that may be a strategy that some people have been looking at because they're anticipating tax rates would be higher in the future. So they're thinking, well, I'll pay the tax now, and then we'll have tax-free future growth on that out into the future. This would say you can't do that. No backdoor Roths would be allowed. Now, what else is in there? This is where we get into I call it the garbage that's in there that's not tax. It's not tailored to, these are the it's not tailored to any specific policy, so to speak. These are just kind of thrown in there. These are the goodies, so to speak. Up to 6 semesters of free community college, free childcare for children under age 6. Of course, these are all paid for with taxpayer dollars, so nothing's free. Free universal preschool services, free health benefits for persons in states that did not expand Medicaid. And this is one thing, we had this debate in Kansas a few years ago. Oh, we need to expand Medicaid. My comment to a lot of politicians was, why? If you don't do it, you can effectively be able to cost shift that to the feds, and you're not going to have to pick it up at the state level, even though the feds were saying that, oh, we'll bait you into that. We'll pay for some of that. No, just don't do that. They'll cave. They'll give in. They'll fully fund it at the federal level. And it looks like I was right on that one too. Expansion of Medicare to cover dental, hearing, and vision care, up to 12 weeks of paid family and medical leave. No oil or gas drilling on the non-wilderness portion of the Arctic National Wildlife Refuge, ANWR. Moratorium on offshore oil and gas leasing in the eastern Gulf of Mexico, the Atlantic, and the Pacific federal waters. And then a really strange one here. Payroll tax credit on up to $12,500 of wages paid to local newspaper journalists by local newspapers or broadcast stations. Now that's got a sunset on it, as you can see there, but that's an interesting one, kind of a funny one to say the least. Now, what will the Senate do? Well, I closed out that conference in Iowa City in June by saying that you really need to pay attention to what President Manchin says. And I said that deliberately then, I say it deliberately now, because Manchin and now Sinema hold the power in the Senate, and whatever they decide is going to determine the fate of this bill, and maybe if it goes through, what provisions are in and what provisions are out, because there will be no Republicans that support this. I don't see that at all. And you have to have all of the Democrats support it, because the Senate is split 50-50. And if Manchin or Sinema or both decide they don't want to support it, then the bill doesn't go anywhere. So they really have the control. That's who you really need to pay attention to in terms of what happens on the Senate side. And Senator Manchin said that he's concerned about the spending. Sinema is concerned about taxes. She doesn't want to raise taxes. He's more concerned, at least publicly stating, that he's concerned about the impact on the budget and the spending. And so he wanted to wait until the CBO cost estimate came out. And they did. The CBO came out with their cost estimate. House went ahead and voted it through anyway, but they said there'd be a net increase on in-budget deficit totaling $389.2 billion over the next decade. And so it's not cost-free. Well, we knew that. It does not pay for itself. Now, that 389.2 is before they factor in any anticipated revenue increase because of additional audit activity by the IRS. So we shall see with respect to that. Now, will Manchin and Sinema consider the current economic problems? So this is at least you would think that those that are voting on these things would process in their minds what putting several $1 trillion more into the economy might do, given the current status of the economy. A University of Michigan survey is out, and on my website I linked to the site where you can find this. They showed that consumer optimism has now plunged to a new low since January of this year. We also got economic data that came out from the Bureau of Labor Statistics, Federal Reserve, other databases for the third quarter of this year. And the third quarter of this year showed that new home sales collapsed to an annualized quarterly drop of 12.6% over the prior quarter a year ago. And third quarter of 21 had the worst ever 12-month quarterly and monthly consumer merchandise trade deficit. So some real problems there, and payrolls are still well short of economic recovery levels. Also, the October 21 consumer inflation jumped to a 4-decade high, and year-to-year consumer price inflation was at a 31-year high of 6.2%. we have had absolutely astronomical money supply growth over the last 20 months. When you take a look at all the bills that have been passed to deal with the economic shutdown created by numerous state governors, not really at the federal level. That was all done at the state level, but the feds have come in and have thrown a bunch of money at this, and it's caused the money supply to grow astronomically. Well, plus we also have policies that have increased have increased the economic problems. And I mentioned economic problems are the result of bad political choices. Well, what are these policies that have done this? Well, we've had policies that have increased the price of fossil fuels, from shutting down pipelines to shutting off drilling, which this bill would continue. That causes price inflation. That gets into the cost of transportation, other costs cost of production, cost of transportation, and that increases the price of all goods. So that's kind of baked into the equation. Fossil fuels are already baked into the economy, and when you increase those prices, you're going to in turn increase the prices on everything else. And also, we've had policies that have created wage inflation. Paying people to stay home has created problems, and now the businesses, to lure those people back, have increased wages. And we just saw this with the holdout at the strike at John Deere, and they were offered 6%, and they struck over that plus a bunch of other stuff. And they said, no, inflation, if we're at 6%, we're not even coming out ahead. So it's got to be at least 8% plus a bunch of other stuff. So you get wage inflation building the economy on top of price inflation. And then you've got massive deficit spending, which creates excess demand that adds even further to inflation. And then really poor policy choices by the Federal Reserve. The near 0% interest rates increase demand, and they further fuel inflation in the economy. And there's really no good reason for interest rates to stay near zero at this point in time. If you remember the last crisis that we went through, the Fed started a strategy of moderation. You get a quarter point increase, and then a quarter point increase, and then a quarter point increase. And they managed that pretty well the last time we went through this. So far, they've done absolutely nothing. And this is why you've got the inflation galloping away when you combine it with all these other policies that are out there. So my question is whether on the Senate side, Senators Manchin and Sinema in particular are going to connect the dots together and see that this bill could create more issues with respect to that. Plus, this man no longer runs the Fed, and that is Paul Volcker. Some of you on the webinar this evening may remember who Paul Volcker was. He's now passed away. But he was the chairman of the Federal Reserve, appointed in August 1979. And in 1979, we were in the midst of what was known as stagflation. We had runaway inflation and unemployment at the same time. And he came in and appeared at a hearing before the Congress in October of 79. And he made this famous quote, and he said, "I am going to wring inflation out of the economy." And he did. He did that by using the tool that the Federal Reserve has, and that increases the cost of money. And by doing that, the way you get that is to increase interest rates. And he did. He increased interest rates. And when you look at this chart, and I want you to think about parallels as to where we might be now in terms of where we might be headed to in the future. You can see the line there, 1979, Volcker named Fed chairman. He launches an inflation busting campaign, and inflation peaked. Did his strategy work? Absolutely, it worked. You can see the interest rates come way back down, and then they kind of bump around. But from basically late 1979, 1980, up to about 82, 83, interest rates went way up, which meant the inflation rate came way down. Now, those of you that were in agriculture at that point in time can remember what happened to you in agriculture, because of the policies in the 70s were to encourage you to continue to expand and buy more land and leverage very heavily. And a lot of those were variable interest rates, which we don't have nearly as much of that right now, and created a problem. And in Iowa, land values dropped about 50% in an 18-month period. And so when you're collateralized very heavily with your land and those values drop in half, many people found themselves underwater. That land was worth less than what was owed on it at that point in time. So this is, I think, a pretty interesting chart. Other than that, those problems, the oil shock and the second oil shock in the 70s, you can see the inflation spike. And then pretty much the rest of the time, it's pretty well moderated. And from 84 to 2007, that's known as the Great Moderation itself. Then you see the housing bubble pop in 2007, you had deflation. And so it went basically to zero, and it's been bumped up a little bit after that to 2%, but we've been basically between 0 and 2% since then. Now that has changed, and I'll show you in just a moment what that means. Now, let me flip through a couple other charts here. The red line on this one are government payments. This is Kansas Farm Management Association data. This is the blue line is decade average net farm income. The bars are net farm income, and this is by decade. And so you can see how brutal it was in the 1980s. And then, the 70s were pretty good. Then the 80s was the crash, and we've been slowly climbing out of that ever since. But look at if you compare 1979 and look at net farm income, that was pretty high. And then it had steadily gone up for about 4 years. That was the fourth year of increase in net farm income, and then the absolute crash. Now go fast forward to 2018. 2015, and then a bump up in 16 on net farm income. 17's higher, 18's higher, 19's higher, 20 is higher. Will we see a crash in 22? I don't have the 21 data there, but will we see a crash in 22? Well, if history repeats itself, we very may well see that. 22 could be a lot rougher than 21 for many farmers. This is a measure of solvency trends. Inflation adjusted solvency trends, and we're kind of on a downward track. We were up 17, 18, and then kind of turned around a little bit in terms of solvency. Not bad, but a little downward tick there. And the effective interest rate is that bottom chart with the triangles through it. And then the bars again are ending total debt. So total debt has spiked up. We haven't seen total debt at these levels. These are inflation adjusted. These are brand new levels of total debt the last 6 years. So we got to be careful with respect to that. If the Fed actually adopts a policy of increasing interest rates, we want to be in a position where we're holding cash and not necessarily paying on debt. This is inflation adjusted liquidity trends. And so you can see the purple line there that kind of bounces all over the place is working capital. That's operating expenses plus interest. The bars are working capital itself. So working capital in pretty good shape. You can see what happened to it in the 80s. That's 79, it peaked. And then 80, 81, 82, 83, 84 really was the crash. And that's where farmers are now using their working capital to pay debt off. So they're eating into their working capital. We haven't seen that yet. It's just we need to be aware that these trends might be out there. This is wheat yield and average revenue per acre. I'll just wrap up these charts here in a second, and we'll get into some of your questions. Real revenue per acre has really bounced around a lot over the last 110 years. When you look at the linear real revenue per acre, it's pretty much flat for 110 years. Real revenue stays the same. Real revenue per acre bounces around. A yield, the trend line is up for 110 years through technology and innovation. And plant breeding and those types of things, that's gone up. Real revenue, the linear relationship, real revenue per acre, flat basically over the last 110 years. Take a look at this. This is the Federal Reserve in St. Louis. Federal Reserve economic data is known as FRED. And this is the M1, the money supply, the basic money supply in the economy. And take a look at what happened starting in 2020. Just an absolute astronomical rocket straight up on money supply. This is how much money is floating around in the economy. This is just showing it a different way, putting it in dollars terms. So let's say that'd be 20,000, 20 million, 20 billion, 20 trillion dollars. Okay. And again, the trend since 2010 has been up, and then just a spike starting in 2020. There's just so much money floating around in the economy, and the classic Milton Friedman definition of inflation is you have too much money chasing too few goods. And that's what causes inflation. You've got the government pumping all this money into the economy, and you don't have production out there. So you're shutting production down, you're pumping the money in, M1 shoots way up, and you got too much money out there chasing too few goods. You've got inflation. That's just a horrible recipe for inflation in the economy. Now, this is the median consumer price index. Take a look at that. You draw a trend line through that up to about 2020, and the first half of 2021, the trend line's down. Look what has happened in the last half of, well, you get into 2021, basically. Look at your spike. There's where the spike is on consumer prices, and just a total skyrocket up. Okay, now let's, we got about 15 minutes left, and there were a number of questions that were submitted, and let me just kind of roll through these questions. Now, which is better and safer to avoid a family feud after one's death, a will, an estate, or a trust? That's an interesting question. The answer is it depends. It's going to depend on your family situation. I've worked with families over the past 30 years where it really didn't matter what the device was going to be. They were going to fuss over things and fight. But I think that's a distinct minority of situations that are out there with respect to farmers and ranchers. Most people, again, it may not matter for many people because they won't fuss, they won't fight. But in general, I think there's a few things that I can say here just with general application. If you have a will, in other words, a probatable estate, and I think the questioner is asking here, the person that submitted the question, should I have a will and go through probate, or have a trust and not go through probate? Well, there are pros and cons to probate. We tend to think, the general feeling out there is that probate is costly, it's time consuming, and there can be challenges to a will, and a trust may cut all of that off. Well, there's some truth in that, but there's some that's not true in that. If you are concerned about if you want a process to resolve disputes, the probate process has a very lengthy track record of court cases, judicial opinions, common law, and that establishes the rules for disputes that come out of probate. Probate puts a judge in place to determine disputes, and then we have the legal process if there are challenges to that will tell us, pretty predictably how things will come out. So there's a process there. Now, is it more costly than avoiding probate by having a trust? Not necessarily, because the process of a will and a probate is that you're going to pay on the back end to have the estate probated. You're going to pay on the front end to have a trust created, and hopefully save that cost with an administrative fee on the back end that would be roughly half of what the probate fee might be in many states. Now, I'm talking center part of the United States. You get in states such as California, New York, and I know there's some on the call this evening that are from those states. The probate system there is different. It is more expensive in those states than for many of the states in the center part of the country. So in those states, we do tend to lean toward trusts. And with the grantor trust rules not being on the table, that would have dramatically changed. And I don't think there's any chance the Senate adds those back in if they do anything with this. Then I would lean toward a trust in those states. If you want privacy, a trust is a way to go, because a will at death becomes a public document. Once that is probated, it's filed, people can go to the courthouse and read your will and determine who you left your property to. That's not the case with respect to a trust. So there are a lot of pros and cons on that. I do have a blog article out there done some time ago comparing and contrasting the two, but it really depends on your family. Some people may need a trust because they have a family member that has particular needs. Might have a handicap, other special needs, and so they need someone to manage their property for them. We would want that person to have their property held in a trust on their behalf, and appoint someone else as trustee to manage that property for them, rather than leaving the property to them outright by the terms of a will. We can set up trusts under wills too. So you could have what's known as a testamentary trust rather than a grantor type trust. So a lot of, it would take us the rest of the evening and into tomorrow to fully answer that question. But really it's going to depend on your family situation and what do you emphasize the most? Do you place a high value on privacy? Do you place a high value on a process, a judge overseeing a process? Well, that's probate. What about cost? If the more wealth you have, you probably want to get into a trust. Just as I'm talking general rules of thumb now. And so the answer is it really depends in that situation. Next question. What are the tax consequences of placing names of the children on deeds to farmland while the parent is alive compared to simply letting them inherit the land upon the death of the parents? Well, tax consequences would be if you put the names of the children on the deeds of the farmland, you've made a gift. It might be a taxable gift depending on the value of the farmland. But you can use the gift tax or the unified credit, the estate gift tax unified credit to offset that during life. And so you would file a gift tax return perhaps, but there wouldn't be any gift tax that would have to be paid. But that reduces the balance of your remaining credit at the time you die. So that is a taxable gift of the value associated with the gift of the farmland. And if you let them inherit the land upon death, then they're going to get, under current rules, which looks like it's going to stay, they're going to get a stepped up basis in that land at death. Now, that may or may not be of any concern to you. It's a concern to the children what their basis might be. Some have said, well, I don't want to leave the I don't want to leave the property to the kids. I just want to go ahead and gift it to them now. And that would mean they're going to take a carryover basis of I gift it outright to them. They'll take my basis in the property. And that would disincentivize them from selling the property because they would have to pay the capital gains tax. That's one way to look at it. Not everybody looks at it that way. They say, well, I'll just leave it to them at death as part of my estate plan. I guess baked into this question also would be, are you interested in them having ownership of it during life so that they can farm it, gain experience, own it while you're still around to watch and observe? And some parents put a value on that. I want to transfer property or put their names on a deed during life and co-own with them. And instead, because I get joy out of seeing them have ownership while I'm still around. So again, this is one of these questions where there's no set answer to it. It's going to depend on your own particular circumstances. What are the issues associated with owning land that is rented out on shares? So a crop share or livestock share lease. Well, you got tax issues. You may have legal issues that come up. The tax issues will resolve around whether this is a material participation or a non-material participation share lease. That's going to tell you where you report the income on the return and hence whether it's subject to self-employment tax. That's one of the issues that's out there. There are other issues if you rent the land out on shares as opposed to, I'm presuming this is kind of built into this question, as opposed to a cash lease. There are other tax provisions in the code that you might be able to take advantage of if you are in a material participation type lease. So a lot of tax issues there. Now some legal issues. We can resolve a lot of legal issues if we get that lease in writing. And so you want to have that lease in writing that deals with a number of issues. If I'm renting it on shares, am I in a partnership? Well, most of the time we don't want to be in a partnership. So get a written lease that says it's not to be construed as a partnership. How are we handling a lot of other financial as well as legal issues? Specify those in a written lease. We tend not to have those in a cash rent situation because we clearly know who the farmer is and all I'm doing is passively collecting some rental income. But you've got a lot of other issues that come up when you are leasing on a share basis. We've already answered this one. What do you think is the long-term outlook for retaining stepped-up basis for transfers of ownership for family farmers and ranchers? If you anticipate that being removed, what can we do to lessen the impact? Well, I don't, that is no longer in the bill. We are going to retain stepped up basis. We are going to retain the current level of the exemption for purposes of estate tax. And so I don't think we have to worry about this one. I put the chance of the Senate adding that back in as zero. If we could go negative on that, I would think there's a less than zero chance that they would add that back in. So long-term outlook now, from a political standpoint, there's really no long-term outlook. Subsequent session of Congress reconstituted after the 2022 elections could change the rules again. So long term, as we talk about this, things may be kind of short term, but I really don't think, and I had mentioned this to the group in Iowa City in June, and I mentioned it to other groups in my private meetings too, that you look historically at things and at the estate tax, the transfer tax system, the estate tax exemption has never gone down, except for the one quirky year, which is 2010, which was a goofball year for this, but it's never gone down. And stepped up basis, they haven't fiddled with that since the late 70s, 1977 and 78. And it was a disaster then. And that's why they repealed the rule retroactively. So I just don't think they're going to revisit that. Okay. So long-term, I would say no change on that. Can I start a corporation or LLC to put some of my income in that to get a lower tax bracket? Well, sure, you can. The question is, how much income is the farm or the ranch generating? Because you want to look at the brackets that apply to individuals compared to that flat 21% rate that applies to a C corporation. Now, the LLC is a flow-through entity unless you would happen to elect to be treated tax-wise as a corporation, and I'm not sure why you would want to do that, but you can. But you want to compare the 21% tax bracket with the marginal rates that apply to flow-through entities, plus the ability to take a 20% deduction on your business income under the qualified business income deduction. So that that will turn a 20% or let's say a 25% individual rate into 20% lower than that. So about 21%. So that evens it out with a C corp that's a flat tax rate of 21%. But there are other considerations than just tax. How does it fit into your overall estate plan? How easy is it to transfer the interest to the next generation, so forth and so on? Can I get into the entity? Can I get out of the entity with minimal tax costs? Those are the things that you want to ask from a more broader standpoint than just simply, well, I want a lower tax bracket. That sounds good, but there are other things to think about in the answer to that question. Do I need to worry about increased taxes on a now 413C? This is the way the question came in, and other investments. I don't think that's what you mean. This could mean one of two things. 401(c), which is a common mistake people make when referring to a 501(c)(3) organization, and maybe transpose the 3 and the C. Or do you mean a 401k, a retirement type plan? I'm not quite sure here. Since it's tied to investments, I'm going to assume that this meant a retirement type plan. Yeah, you do need to worry about that if you have in excess of $10 million in your retirement accounts. That seems to be the threshold right now. That's where they've drawn the line. That is in the Senate bill. I think that will stay in the Senate bill. That is a way to generate revenue that wouldn't be too politically unpopular. So if your investments are rather large, then I think you do need to worry about increased taxes on those investments. Is now the time to convert from a type C corporation structure to convert from a C to an S for your family farm? What are the key decision points to consider when making this decision? I mentioned some of these already. Convert from a C to an S, you can do that. There is a step-by-step process to do that. What you have to worry about is if you have built-in gain on the assets that are in the C corporation during the time that it was a C corporation. If those have appreciated in value, then you might trigger what's known as the built-in gain tax. So what you're going to have to do is make the S election and then wait it out for 5 years, or have your tax accountant or your tax attorney keep that S corporation. You make the S election, you go C to S, and then have the S keep its income at 0 for each of the 5 years, and then you're not going to have to worry about the big tax at all. Now, decisions in doing that, the C corporation is pretty inflexible structure, and we don't want to put land in a C corporation under the current rules. And so a lot of people have these older C corporations that are out there that they do want to transition to an S corporation. That can be a good plan, but you do have to be wary of the built-in gains tax and then what I call a sting tax on passive sources of income if you're going to go from a C to an S. So you got to watch your cash rent leases. If you go C to S and you're cash renting out that farmland, then that can create some additional tax problems. So there are a lot of things to think about in that question too. And again, you want to look at the amount of income you're throwing off. What bracket are you going to be into from an individual rate? And then remember, the C corporate rate is at 21 right now. You could push yourself into a higher tax bracket just from a pure income tax standpoint. There's no one with appreciation of Kansas agricultural land to leave it to at my death. Rather than allow the land to be sold, I want to donate the land, perhaps the local county community foundation. I appreciate your advice. Well, if that's what you want to do, and that is certainly an admirable plan, there are groups out there that would gladly accept gifts like that. What you want to be careful of is to be very specific with what you want that land used for. There have been donees in the past that have misused those gifts in accordance with the donor's intention. And you want to get to an attorney, have the documentation drafted up, make sure the gift is clear as to what your intent is and what you want that to be used for. You can even do this outright during life. You can do it at death, but be very clear on what your desires are, and so that land is used in accordance with your desires after you pass. What to do when you have no farming children and you'd like to see the farm and the ranch that the parents have worked to improve continue in the family, I presume is what they mean here. Well, if you have no farming children, one of the things you can do there is you can still leave it to your children, but have them continue to own it, put restrictions on that, and you can do this, you'd have to do this in a trust, put certain types of restrictions in there that say, well, we really need to come to an agreement, maybe unanimous agreement in terms of ever selling that farmland. Otherwise, then the non-farmers end up becoming tenants. They lease it out to somebody else to farm, but they continue owning it. Is a trust a must for passing the inheritance to adult children? Well, in that situation, I would say it is, in order to build in the requirement, the language, to keep that in the family as long as possible. But again, note that the children would not be in a managerial position. They'd be in an ownership position where they would lease that land out. Working on planning this year's taxes, expenses, allowed deductions, and depreciation. Really, we haven't seen too much change there with the income tax rules since TCJA. So, the expenses allowed are the same, the deductions are the same, depreciation rules. We continue on with bonus depreciation, expense method depreciation, in addition to your regular depreciation. So not much change in the landscape there. And then I think this is about the last question, and I've got to stop here. A family has a trust. I'm the trustee, and each surviving spouse is trustee. Each of our children receive a portion of the farm plus a portion shared by all of them. With all of them farming, what would happen if I changed the trust? Well, there's one way to answer that question, and that is go ahead and change the trust and see what happens. But that one is going to be dependent on what you want to change about the trust and what that would do with respect to how the children view those things. So that one, again, we'd have to visit on that one and get more specifics on what you're thinking of doing, what you're unsatisfied with right now, and whether the terms of the trust would allow you to even change the trust terms. And that's where we want to start with. We'd have to read that trust instrument first. Well, Lavelle, I'm going to turn it back over to you. I went about 4 minutes over on this, but those were all of the questions that were submitted. I think I went through every one of them as fast as I could and as thorough as I could in the time constraint. Again, I want to thank the Women in Ag group for the invitation this evening. Thank all of you for spending your time with me tonight. There's a lot of things you could do with your time, and I appreciate your attention. Feel free to contact me whenever you have questions. Visit the website and follow me on Twitter if you're into Twitter. And I think you'll pick up some good information that way. Lavelle?
Yeah, Roger, thank you for doing this tonight. We did have about a half dozen questions come in. Would you be okay with answering a couple of those real quick?
Sure.
Okay. All right. A question about what became the proposed changes to the 1031 exchange.
I see nothing with respect to 1031 exchanges that remains in the bill. Now, keep in mind, and this is a caveat I made in the blog article. I think I've got it correct as to what's in and what's out. The 1031 I'm not seeing in there. Now, this is a several thousand-page bill, so it's entirely possible that I missed something. But with word searches and so forth, and trying to track down the version that actually was voted on, because there were last-minute amendments and things that got cut at the last minute. So you're always, at least I'm always a little bit worried. Am I actually looking at the final version? I think I am, and I think I was. And I don't think there's any change in the 1031 like-kind exchange rule from TCJA that made it into the bill that the Senate is now considering, which means we could still have real estate trades, but no personal property trades. I haven't seen anything that would indicate otherwise.
Great. You had an earlier slide talking about paid leave excluded from gross income. Can you define that? And does it include vacation and sick leave?
I believe it does, and I'm going off of memory based on reading that section in the bill. I think it's a pretty broad brush. Paid leave is defined as any type of paid leave, but it's tied to paid leave paid under the Social Security Act, which is excluded from gross income. So I would have to run that through to see what type of paid leave is paid under the Social Security Act, because that's the language in the bill. It has to be paid leave paid under the Social Security Act to be excluded from income.
Okay, very good. You also talked about the $10 million in retirement account. Is that per person or per couple? Could you define that?
That is per owner. So if an owner has multiple accounts and the cumulative amount is in excess of 10 million, then you get into these restrictions on inability to contribute more, and you have to take distributions of a certain amount of the excess over 10 million.
You also talked about the steps to convert from a C Corp to an S Corp. Do you have a blog article that people could reference on that?
I do, yes.
Okay, all right. We will try to find that blog, or we will find that blog article and try to send that out to all of the participants. So that they can...
I think it was 3 to 4 years ago I did that one. So it's not in the last year or two.
Okay, great. We'll wrap it up with a final question. Regarding the inheritance with a daughter who doesn't want the real estate in the estate, which her brother's farm, what happens regarding her tax-wise or capital gains when they buy her out?
Okay, so I'm assuming that the person that provided the question is saying that I want to leave my property equally to all the kids. The daughter's not going to farm, the boys are going to farm, so they have the right to buy her out. So she's going to get cash and they're going to get the land. Is that kind of your understanding of how that question reads?
I think so.
Okay. So they buy her out. She gets a stepped up basis in her interest in the real estate. So if they buy her out for that value, there is no gain that has to be paid on that. Or if they pay very close to that, it'd be very minimal gain. That's where that stepped up basis rule, that's a good example of that stepped up basis rule coming into play. And I mentioned early on this evening that that rule is important to everybody in ag. That can affect just about everybody, whereas the exemption being at basically 12 million doesn't affect very many. Now, those that it does, of course, they're very concerned about it. But basis step up is critical to everybody. That's why that rule was very important for that rule to be retained. So she's bought out for basically the fair market value of that land shortly after death. That's going to be pretty close to what her basis is, which means that there won't be any gain.